Good afternoon. Hello, this is Arya Apte, your finance group teacher. Let's start our second book, which is FMG 406, Introduction of Business and Industry and Indian Financial System, the Banking and Banking Finance, which these are the important factors. Yes, we started for introduction for business, industry, and commerce. In that, the concept of business, feature of business, and stakeholder business, classification of business activity, barter system, origin of money, functions and money in economy and money supply. These units, these first units we already finished. Now we go for Indian financial system, which is introduction of financial system and functions of financial system, structure of Indian financial system, growth of development of the Indian financial system. So these are the main stream of related unit, which is unit number 2. Let's we start from there. Yes. Economic growth and development of any country depends upon a well kit of financial system. The financial system companies to set a subsystem of financial institutions of financial market, financial institutions and services which help in a formation of capital. Thus the financial system provides the mechanism of which saving the transform in investment, and it can be seen the financial system play in significant role in economic growth of the country by the mobilizing the surplus fund and utilize them effectively. The productive purpose, the financial structure refer to shape, uh, component and their order in the financial system. The financial system system, companies, financial institutions, and financial markets. The financial institutions and financial services that continuously monitoring by the various regulatory authorities, namely the Reserve Bank of India, Securities and Exchange Board of India, and Insurance Regulatory and Development Authority. The main aim of the unit is to introduce the financial and structural Indian financial system along with the detailed description of such components like financial system. In this unit, we are explore the various factors related with financial sectors. In this unit, we after that we can just after after sending this unit, the unit. Sorry for disturbance. The economic development of nation is reflected by the progress of various economic units, such as corporate sector, government, and household sector. These economic units can be classified into following categories: saving surplus unit, saving deficit unit, the whole investment expected unit. So they given the nature things which are related with the financial sectors. Financial system is today's world in appears most important system among the all systems in economy of the world. They have become interlinked to has become a very complex system. The financial system is include all where it bank and store markets of the financial institutions. The financial system of the financial sector functions as an intermediary facilities the flow of funds from the areas of surplus to areas in deficit. The financial system companies, financial institutions, and financial markets. Financial institutions and services that help in a foundation of capital by transferring of funds in it provides a mechanism which saving are transformed in investment, and these investments are used for the economic development of the nation. The Venn horse defined as the system in allotted saving efficiency in the economy to ultimate user, either the investment in real estate or for the consumption. It is a complex integrated set of substantial this subsystem after financial institutions in market and industry. According to Chandra, the financial system consists of the various institutions, markets, and investments related in a systematic manner and provide it Principal means by which the saving are transformed into the investment. Supply of funds, household, business loan, government, foreign investment, flow of security, financial institutions, market institutions, flow of funds, user of the funds means supply and user. These are the main factors which are related with the finance and household business, business firms, government, and foreign investment. These are under use of funds and in the supply chain, the household, business firms, and government and foreign investment. So these are the main interlink between the financial institution and markets. Function of financial system. The financial system is the network of financial institutions, financial market, financial investment, and financial services. The facilities to transfer the funds. The system consists the several intermediary instruments which are ultimate user of the fund. The level of economic growth largely depend upon a facility by which the financial system prevailing the economic efficiency. In financial system, the substantial of economic growth are coordinate, coordinately. The financial system mobilize the services and channelizing them into the productive activity and thus the influence of the piece of the economic development. The economic growth is happier from which the effective financial system. The financial system of the country perform the various important factors for the economic development of the country. The main factors of the financial system are the following: the mobilization of the services, allocation of funds, development of trade, and the settlement of the commencement of the transaction, which are the main terms of these financial system. Next is liquidity, risk, protection, and overall economic development. So these important factors which are related with the financial systems. Uh, these functions are very important in your examination point of view. They ask what are the financial system and what are the functions of related to that. So you can explain these all factors in brief. Next, structure of Indian financial system. The financial structure refers to the shape of the components of their uh, order in the financial system. The financial system, companies, financial institutions, and financial markets, financial institutions, and the services like various regulatory authority, namely the Reserve Bank of India, Security and Exchange Board of India, Insurance Regulatory and Development Authority, and the description of various components of Indian financial system is given in various manner, which we are doing explain in follows. The financial institutions given a physical presence to the system and provide a functional infrastructure. They encourage saving and make for the optional allocation. They make one type of contract with a borrow and other type of the leaders. Two world, they perform the functions of financial intermediary. The financial institutions are the intermediary who finance facilitating the smooth functioning of the financial system by the making investments and borrow the meat. They mobilize the saving of a surplus until they allocate them into productive activity, promising the better rate of return. The financial institution also provide the service to entitle seek advice to the various issues, rearing from the restructuring to diversification plan. They provide whole range of services to the entire who want to raise funds from the market. Else, Elsewhere, the financial institution act as a financial intermediary because they are act as a middleman between the saver and borrower. On a base of the nature activity, the financial institution may be classified in regulatory and uh, promotional institution, banking institution, non-banking institution. So the regulatory promotional institutions, the financial institutions, financial markets, and financial institutions, financial services are all regulatory by the regulating like Ministry of Finance and Company Law Board, RBI, SEBI, and IRDA, the Department of Economic Affairs, the Department of Company Affairs, and etc. The two major regulatory promotional institutions in India are Reserve Bank of India and Security Exchange of India. Both SEBI and RBI administratively, legislative, supervise, monitor, and control, discipline the entire financial system in RBI. SEBI have the lead down the several portion of the procedure and the guidelines. These policies produce the guidelines and change from the time to time so as the set of financial system in the right direction. Next, banking institution. These institutions are mobilizing saving of the people. They provide mechanism and smooth exchange of the goods and services. They extend credit while leading money. They not only supply the credit but also the credit create credit. These are the basic categories of banking institutions. They are commercial banking, cooperative bank, and development bank. The commercial bank in India carry the more two-thirds of the asset of the financial institution. The commercial bank can be feature of developing into four parts of following. First is public sector. Public sector, they may be financial institutions and in the intermediary, the financial institutions, financial markets, and financial services. In these banks, the majority stake in held by the government of India and Reserve Bank of India. The public sector in India, banking emerged the present portion in the three stage. Finally, the corporation of that this existence in pair Bank of India into the state 1940. So about of 7 states. Associated Bank is subsidiary bank, secondary, the and 14 major commercial banks in 19 July 1969. As early, the nationalized of 6 more commercial banks in 15 April 1980. Thus, the 27 banks are consistent in banking, public sector, and Indian commercial bank. The public sector account for the 90% of total banking business. The State Bank of India is the largest commercial bank in terms of voluntary of all the commercial banks. In the case of private sector, the bank, the majority of the share capital of the bank is held by the private individual. These banks are registered in companies with limited liability in 1994. The Reserve Bank of India issued a policy of liberalization, license of limited number of private banks, which issued in a new generation tech bank, Global Trust Bank, and the trust of the first private bank after liberalization. It was later amalgamated with a original bank of the commerce OBC, later the Housing Development and Financial Corporation Limited, become the first institution to receive an A principal approved from the Reserve Bank of India to set up a bank in a private sector. The present private bank in India is the leading the ICICI Bank, ING Vaishya Bank, Jammu and Kashmir, Karnataka Bank, Kotak Mahindra Bank, and the major role in development of Indian banking industry. Such they have made the banking more efficient and customer friendly. In the process, they have joined public sector bank and they are completely focused on become a competitive. So these both type of banks like private and public, they can build a Indian economic system very brightly. Next is foreign bank. The bank are registered in have their headquarter in foreign country, but the operation their branches in India. Some of the foreign banks operate in India, they Hong Kong and Shanghai Bank Corporation, HSBC, Citibank, American Express, Bank and Standard Chartered. The number of foreign banks operating in the India has increased since financial sector reform 1991. The operation in India, foreign bank have to obtain a license from Reserve Bank of India. Regional Rural Bank. Regional Rural Bank were the first established in October 2, 1975 and are playing a provide role in economic development and rule of India. The rural bank have been established the need of the weaker sectors of the society. The main goal of establishment of the regional rural bank in India is provide credit to the rural people who are not economically strong, though especially the small farmers, agriculture labor, and even small entrepreneur regional rural bank were convincing the low cost of institution having a rural ethos, the local feel and pro poor focus. If every bank were so sponsored by the public sector bank. Initially on 2nd October 1975, the 5 regional rural banks were set up with a total authorized capital of 1 crore, whereas later argument the entire 5 crore. There were 5 commercial banks, Public National Bank, State Bank of India, and Syndicate Bank, Union Bank of India, and Union Commercial Bank, which sponsored regional rural bank. Regional rural bank are regularized by the National Bank of Agriculture and Rural Development, means NABARD. The RRB were owned by the 3 entities where are respective share as follows. Central government 50%, state government 15%, and sponsor bank 35%. So these are become the integral part of the success of the Indian financial stories. They have achieved the landmark since they are created help in a nominal rural bank to fill the employees as secure. A cooperative banking financial entity, the belonging in the members, who are owned by the company. Same state, hence the state government regular these banks in 1966. These are need to regular banking to either soundness of the protected interest of the depositor, considering the certain provision of the Bank Regulatory Act 1949, where they made application to the cooperative bank as well as cooperative banks can be uh, further classified in private agriculture credit society, district central cooperative bank, state cooperative banks, and land development bank. The bank financial institutions also mobilize the financial resources directly or indirectly for the people. They had funds, but they do not create credit. The companies as which has license LIC, GIC, and UPI, the development of financial institutions, the organization pension and provision fund falls into the category. Non-financial institution can be uh, categorized in investment of the companies, housing company, and the realizing the companies here the purchase company specialize the financial institutions. Pension and provision fund into fall in the category. Non-banking financial institutions can be categorized as investment companies, housing company, leasing company, and hire purchase companies. Specialized the financial institutions. Investment in state level. Finally, with the regulation government, these institutions are relatively lighter as they compare those fund banks secondary, and they are not subjected to central regulatory pressurized to applicable to the bank. Some of the NBFI national bank financial institutions are discussed below. Tourism Finance Corporation of India (TFCI). The goal had to pursue the recommendation of the National Committee for Tourism. Decided in 1988 the permit to support all Indian financial institutions for providing financial institutions and tourism related activities. The General Insurance Corporation, the general insurance business as the national general insurance business. The General Insurance Corporation of India has formed as a pursuit to section. It is a corporation 22nd November 1972 under the Companies Act 1956 as a private company limited by the share. GIC was formed as a purpose of superindicated control and carry on business general insurance. It has number of need-based insurance scheme to meet a diverse and emerged need of the various segments of the society. Import-Export Bank of India. The Bank of India examined the Import-Export Bank of the India. It is permitted to export financial institutions of the company. Set up in